Welcome to the Real Estate Investing Morning Show with your hosts, Wayne and Gabby.
Hey, good morning, everyone.
Just want to make it seem like, you know, in the news where they come in and they're just like, okay, yeah, and we're live. Yeah, yes, we are broadcasting to you, coming to you at prime time. What do they say on the news?
Coming to you live.
Coming to you live. Nah, that's not what they say.
On
Anyways.
location.
No, that's not what they say. do you even watch the news, Gabby?
No, I don't.
Neither do I.
I don't.
Well, welcome to the Real Estate Investing Morning Show, like Gabby said. We're happy to be here. Today's episode, we're going to be diving into helping you guys come up with a plan. And maybe we will, maybe we won't. I don't know. This is one of those ones that this is something we normally work with our students on, one-on-one. And I would say, like, most of our students, we don't even get into this until like the second or third year. Because when you're thinking about how many rental properties you need, it's a pretty complicated question because it really depends on you and your goals. And if you're a new investor, it's kind of hard to figure out how many properties you need because you don't even know how many properties you can get yet, and you don't even know what you're capable of. So it's like trying to come up with a plan, before you even learn how real estate investing works or what is truly capable is pretty difficult. So I say all that to say we're going to do our best, and this is something that's normally much, much, much more advanced. But we had a question come in from a recent birthday boy. I'm not going to say his name on the podcast because he didn't say whether I could or not. But it's a recent birthday boy sent in an email over the weekend, and he had a question about when is it possible that I can start seeing some of this cash flow? When is it? How many properties do I need? How do I structure this? What does it take? And it inspired today's topic, which is, how many rental properties do you need, really? And so we're going to be diving into that. Now, as you guys know, this is are we into our third week now, technically, or second week of the podcast?
Yes.
We're restructuring things on the podcast. We're trying to figure out, I have an idea of how I want all this to look, but I'm slowly easing everybody into it and slowly easing ourselves into the new structure and the new format as we are now live in video, as we did over 1,100 episodes in audio. This is all very different. And some people have been asking about the weather and wondering why the weather hasn't been done in a while. And that's very simple. We just haven't figured out where we can squeeze the weather girl in yet. There's no room in this camera frame here. Where could she be? Could we stick her face like right in here? But we are trying to figure that out. And we're going to give it a shot today. Lots of people across Canada have been wondering what the weather is looking like. So if we could, would it be possible that you would let us know what is the weather looking like across Canada today?
The weather today will be 19 degrees in Edmonton, 19 degrees in Vancouver, 12 degrees in Toronto, 14 degrees in Halifax.
Thank you so much.
Thanks, Evie. There you have it. The weather girl. Live and in color.
Live and in color. She too has to get up early and get showered up and ready to be on video, which is different. It's different. Different.
We're all starting to get used to it, though, I think.
Yeah?
Yeah. I think today for me was pretty smooth, pretty easy.
Are you getting in the hang of it? It's Monday, so Monday's always a little bit harder after the weekend to kind of get back in the rhythm of it. And let us know in the live chat here, those of you guys that are live with us on YouTube this morning, would you be able to do this? Would you be able to get live on video at 7 o'clock in the morning? It's certainly easier than 6, I'll say that.
Yes. Yeah.
But it's a challenge, but we're really happy about it. And we're really happy to be here and providing this resource and this service for you guys across Canada for the real estate investing community to be able to answer your questions, to provide you free education and coaching so that you guys can get the confidence and the clarity to go and take action. Now, before we get into today's topic, there are a couple upcoming events if you are in the Edmonton area, or like I said, I've said many times, if you like various modes of transport.
It's going to be a good week.
It's going to be a great week. So this Wednesday, I'm going to be speaking at the Edmonton Real Estate Investors Association, doing a fireside chat there. So if you are in Edmonton on Wednesday, come on out. It is at the ATB Entrepreneur Center. You're going to have to Google it. You're
not 100% sure where it is.
It's in my calendar. I could try and pull it up, but if you Google it, the Edmonton Real Estate Investors Association, you'll find it there, no problem. It's like $20, I believe. Come on out. It's going to be a really good presentation if you want to know what's really truly happening in Edmonton. I'm going to be pulling back the curtain on that and talking about upcoming opportunities and strategies that real estate investors should be paying attention to as the future unfolds. Additionally, this Saturday, the sold-out REI Masters Edmonton Real Estate Investing Bus Tour is happening as well. Yes. Very excited for that as well. We have 3 amazing stops that we're going to be taking everyone to. One of them is our property, one of our projects, and the other 2 are our students. And these are we handpicked these because these are 3 of the best opportunities right now in the Edmonton real estate market for real estate investors. These are the best cash flowing, best ROI, best, top of the top opportunities right now. And you get to see them real life, live in person. And we're going to be going through the numbers, going through all the details and everything with you to give you, that confidence and that clarity to be able to go and do it yourself. So really great opportunity for in-person education this week as well. Like I said, if you're in Edmonton or if you want to hop on a bus or a plane, it's not going to be something you guys want to miss.
Can't wait. I'm really looking forward to it. It's going to be a good week. It's going to be a good week, Wayne.
Who do we got joining us in the live show on YouTube today? If you guys want to join us and on YouTube live during the live stream of this, just look up Wayne Hillier on YouTube. It's that simple. And we are live every weekday morning at 7 a.m. Who's joining us?
Yeah, we have Chris here. Chris says, happy Monday, you awesome people.
Wow.
Yeah, Nori's here. Nori says, good morning. We have Fabian who says, top of the morning.
Nori, our weathers are the same.
Yeah, matchies, samesies, twinsies. Kristen is here, says, another beautiful day. Carmen says, good morning. Kyla says, good morning. Charn's here, says, GM, everyone. KT Mondo is here, says, good morning. Who are you, KT Mondo? Chantel says, good morning.
Okay.
Here. Manny's here with us. Tristan's here with us.
Manny in the morning. Just saying, Manny, that's a good name for a podcast or a radio show.
It is. I like it. Joey is here with us. Let's see here. We have a whole bunch of people happy about the weather girl being back. Tristan says, cut to the green screen.
the weather screen?
Yeah.
Yeah, that's good. That's not a bad idea, actually. Oh, that's okay. Down the road. One thing at a time. This is tough enough as it is.
We'll get there.
Oh, I thought you were still going through names.
Oh, okay. Sorry. I thought you had something to say.
Nope.
Yeah, I think I got everybody. Chris said, good job, Everly. Kristen said, yay. Kyla said, nailed it. Carmen loved it.
Chris says something about long showers. Is this a dating profile?
I don't remember why he said that. It made sense.
I like walks on the beaches and long showers.
Yeah, I don't know. I don't know what he said that to.
Yeah. Okay. Anyways, like we said, today's topic we're going to be diving into is how many rental properties do you need? Are you excited for this topic, Gabby?
I am excited for this topic. I think that it's going to, I think there's 2 ways that we can look at this. I think for some people, it's going to make them realize that they don't need that much to have a really good life.
Mm-hmm.
And I think for Sorry, was I talking at you?
Into the microphone. You got to
Sorry.
find a way to be able to.
It's hard because I'm used to when
I could hear your audio dropping off as you were looking at me.
when we did this by audio, I was looking at you,
Yeah.
right?
I know.
Not at a camera.
I know.
And I like looking at you.
I like looking at you too. But I'm looking.
So, sorry. What was I saying? Oh, I think that for some people, this topic of, how many properties do I actually need is going to make them realize that they don't need that many to have a really good life, right? But then I think for others, they might realize, oh, if I want to be like living the high life now or in the next, several years, that I'm going to really have to amp it up. Right. So I think there's two different perspectives that might come out of this. And I think both are great for the two different, I mean, there's more than two different types of people, but I think that we're going to hit a broad spectrum of people who might have different realizations or different takeaways. Right.
Yeah. I'm not looking forward to this topic.
Oh, how come?
Because I'm thinking about the third person, which is, I think, makes up a majority of the people.
Okay.
The third person is the person who wants it all right now, that has zero patience.
Okay.
Which makes up, I would say, a large majority of the real estate investing community. And maybe that's their fault. Maybe that's other people's fault, setting unrealistic expectations.
Yeah.
But everybody wants it all right now. They want to leave, and I think it has to do a lot with I'm going to say it. I'm going to say it has a lot to do with other people setting unrealistic expectations, because the way that most people get sold into real estate investing is financial freedom. That is the magic words, financial freedom. Jeremy, if you could just have that, or Jamie, can you get that edited? It sells. It sells programs. It sells courses. It sells seats. Most people they heard about real estate investing in rental properties. They thought it would just be a really cool idea to invest in that, because they heard that real estate goes up in value. They thought it was a good asset class to be investing in, and they started there. And then someone somewhere along the way said, "Well, wait a second, buddy. Why stop there when you can quit your job too? You could be financially free." Passive investing. Why would you put your money into, just something like this that just kind of grows? That's boring. Why not just buy real estate, and then you could own apartment buildings, and you could be the guy that walks around with the big keys, and you don't need to do anything. You can live on the beach, and you can quit your job and tell your boss to go fuck themselves. And then as soon as you hear that, it's like, well, shit, yeah, that sounds great. Okay, yeah, cool. I want that. And then suddenly it's like, there's no going back from that. And even some of our students who, have realistic expectations, and we're very clear with them from the beginning on what to expect and what's possible. There is a lot that's possible. But again, like Gabby said, it's a lot of work. But even some of our best students, as a coach, I'm constantly like checking them a little bit, because they start dreaming big, but as soon as they latch onto that, it's like, it's that, almost like the hot air balloon. They're just like, oh shit, it's taking me up. They don't realize how high they're going. And then it's almost like they look at their life right now and they're just like, it's pitiful. I'm not a peasant. I'm worth so much more. I'm going places, baby. I don't have to put up with that shit every day. And then they almost they almost feel like they're better than everyone. They feel like they're better than what they've built and what they are, and they're better than their job. And they start checking out before it's checkout time.
Right.
And you have to be patient. And it's a conversation we had with our students last Thursday at our weekly coaching session. It's a conversation I've had with many of our students who have stayed with us for more than a year. These are the type of people that really understand the strategies. They got it all figured out. They've got a plan. They got a roadmap. But they have a problem. They're incapable of just being patient and waiting it out. And that becomes a problem, because then they try and rush things. Mm-hmm. Or I've seen some people just give up altogether. which is another weird thing. It's like, okay, now I got to figure it out. I have a full roadmap to financial freedom. Figure it all out. It's going to take 13 years or whatever it's going to take. But 2 or 3 years in, they quit because they're not willing to wait 13 years. It's so funny. They're like, no, I want it right now. No, I really want it right now. No, no, I'm going to do it. And then they do it and they burn themselves out. And then they just go right back to their old life. And then they don't see it through.
Yeah.
As a coach, this is one of the most difficult things that I have to deal with. Is really I'm really, really good at teaching people how this all works, how to do it. The next big hurdle that we run into is getting people to actually do it. Right? Some do, some don't. But the ones that do it,
They do.
it works out really well. And then the next hurdle that we run into is patience and just seeing it through and just consistently showing up every day, consistent. It's a new job. And it's a very, very comparable to the old consistent that you used to have, the old mundane, go to work, check in type thing. Now you have a second job that you need to go to work, check in, do the work, stay consistent. So now it's almost like you've doubled up on it. But if you can see it through for whatever period of time you need to see it through, you'll build it out and then you can finally reach that financial freedom. But truth is, not many do. Not many do. It requires resilience, requires dedication. It requires a desire for something, like a real true desire for something more. And you got to really, really, really want it bad. Really want it bad. Now, that's for the people hunting and fishing and looking for financial freedom, right? Majority of people, similar to what you said earlier, Gabby, you don't really need that much. And I think that I blame the people that planted that in your head in the first place. There's some audacious goal that most people never achieve. When most people just need to realize that, like, remember why you got into this in the first place. You wanted to invest in something that was going to get great returns, that was safe and that was reliable, that was going to help you grow something more for yourself, for your future, for your retirement, something to leave behind for your kids. Most people don't need that much. And if you stick with it and you just have a really good system and a really good roadmap, you can actually build out a really good life for yourself in the future, decades from now. You could leave something really, really great behind for your kids. And you can create that generational wealth like we were talking about last week. Was it on Friday or Thursday? Right? You can make sure that your children or your future generations aren't victim of intergenerational really cool term. It wasn't. Give up. Don't become a victim of dropping in the wealth classes because of just the circumstances with the world and where the direction. Just listen back to the last week's episode. There's a term that I'm trying to come up with but
I can't think of it either.
You don't want to see your kids going in the opposite direction of you, or in a reverse direction of getting lower and lower and lower into the lower classes because of the fact that you weren't proactive. You weren't taking the necessary steps in order to make sure that you left enough behind for them so that they had opportunities. You can also trying to get back on track here. Sorry. I think it's our responsibility to make sure that we make smart financial decisions, and not just for us, but our future generations, to make sure that they have a better chance, right? So just even a few properties can absolutely change the trajectory of your life, can change the trajectory of your future generations, right? And I think it is a responsibility of ours now. And maybe it might not have been a responsibility in the past, but it's becoming more and more important for us to make sure that we are making responsible decisions financially to make sure that future generations aren't in a worse off position because of what we failed to do, right?
Yeah.
So we'll be diving into that. This can go in so many different directions today, guys. And this is why I said, like, I'm not looking forward to this episode, because this is advanced coaching. This is very advanced coaching. And what I do is I work with each of our students individually and tailor a roadmap out for them individually. It's tailored. It's like, it's like the best suit ever made, but it's going to look silly. My suit's going to look silly on you, and your suit's going to look silly on me, right? Unless it's tailored specifically to our measurements. So you really need to truly understand the individual to figure out what's best.
I like that.
So it might, the question that we're going to be reading here after the commercial break, is very much focused on the financial freedom, but I don't want people to get tied to that. I'm just going to preface this by saying I don't want people to automatically hear financial freedom and then suddenly everybody starts going in that direction. Each of you have your own individual goals and have your own individual resources. So we need to figure out what's right for you. So I'm going to answer this question for this individual, but then I want to dive a little bit deeper into figuring out how many rental properties you may need for your portfolio. We're going to take a quick little commercial break and we'll be right back.
You are a professional real estate investor. You are not a professional boxer. And you are definitely not a professional bookkeeper. Enter Fingo. Fingo is a professional bookkeeping service by and for professional real estate investors. Your life just got a whole lot easier, and your profits are ready to soar. Leave the bookkeeping to Fingo so you can focus on what's most important, finding the next deal and raising money for it. Schedule your free consultation at fingo.com.
Intergenerational downward mobility. That's a tough one to remember.
It's a mouthful.
It's a mouthful. Yeah. But we were talking about it last week, and I'm just like, there's got to be a term for it. And sure enough, there is. Definitely go listen to last week's episode. I believe it was on Friday. It was on Friday. Really, really great. Really eye-opening. What's going on in the chat? I see lots of messages going on in the chat here this morning.
Sounds like Fabian is all in on the conversation. Yeah, it's a whole bunch of comments here. I don't know exactly. I mean, I don't know exactly what he's commenting on because he said a whole bunch of stuff, but he did say success is not based on how many doors one has. Unrealistic expectations. Yeah.
Okay.
There's a whole bunch of comments here.
Great. Okay. So nothing really of any substance.
Kyle also said so much misinformation out there that can get people into trouble.
Got it.
True. Hard to read through all these. Y'all are chatty again this morning. Yeah, that's about it.
Okay. Great. All right. Okay, so let's dive into it. Gabby, you read the email that came through.
Got it. Okay. Says, congrats on the new YouTube format. I've been listening to your show religiously for about a month now and have been learning so much. Can't thank you enough. I'm 40 years old now and I am at 9 doors and I am feeling what you guys call rich on paper. Are you able to elaborate on when I can start to pull money from my portfolio and the methods of doing so? Cash flow, sell, refinance, etc. I'm looking for financial freedom to be able to step away from my oil field career and spend more time with family. It seems that refinancing is impossible without a day job. The banks always want that personal income. Is there a way around this, or do I need to accept that this freedom won't come until I'm 50 and the cash flow is sufficient?
Well, that last part would be great. If you could just accept it. Excuse me 1 second. I shouldn't be coughing into the microphone.
Sorry about that.
Live show. This is my first cough.
Your first cough fit?
Yeah.
Yeah. Sorry, I forget what I had a thought.
It'd just be great if you would just accept that last part. That's one of the biggest issues, I think, is that kind of going back to what I was saying earlier, just about, and I'm trying not to be rude. I'm not trying not to be rude because there's nothing worse than someone comes along and just tries to crush your dreams.
Right.
You know, someone told you could do something, and then I come along and say, nah, it's not fucking possible. No, don't listen to them. That's not possible. You can't do that. Of course, naturally, and I would do the exact same thing. Naturally, I'd say, fuck that guy. I'll prove him wrong. And I love that. I love that. I think that's great. I would encourage you to say that to me. I would encourage you to have that mentality. It's just, I've been doing this for so long. Mathematically, you're gonna need to, even if you just went balls to the wall, and some people have done this with true determination and consistency and resilience. Some people just go balls to the wall and they will buy as many properties as they need to buy, but it's still not enough mathematically. You know what I mean? Like, I think that if someone realistically wanted to have financial freedom, like right now, they would need about $6 million. $6 million. And the ability to qualify for all the financing.
Right.
Which was a whole other problem. Like, and you kind of touched on that, the whole refinance thing here, which I'm going to be getting into. I'm going to be super negative today. I don't think there's any way around it. And I'm not trying to be. I'm trying to be realistic. So I hope that everybody... I had a goal today of being positive. I just don't think it's positive or possible.
And I think there's a difference between, well, you just said both words, being negative, but then being realistic.
Yeah.
And I think what needs to happen here is just an education piece on how long it takes in the market before, like with long-term investing, when you're sitting on, like this person that wrote in is at 9 doors. That's amazing.
Which is fantastic.
Yeah, that's absolutely incredible. And I don't know how long they've had said 9 doors, but if somebody today was to go and buy 10 rental properties today,
yeah,
they can't expect it to automatically generate something incredible for them to go quit their jobs.
Yep.
You know what I mean? And so it's just the educational piece of how long do you need to sit on those, and do you need to operate them as well-oiled machines, well-oiled businesses before it turns into something else. And that's what real estate investing is, what long-term buy and hold is.
Yeah.
Is it's a business that you sit on, and you run a well-oiled business until eventually everything kind of compounds and produces something for you.
But how long, Gabby?
Exactly.
Is the question.
And that's where patience comes in.
Well, no, I mean, like, how long? How do you mathematically reverse engineer this? So this is what we would do with our students: is we would figure out what the actual plan is. In order to figure out what financial freedom is, or when you can get financial freedom, or when you can, we need to figure out what's the target first. We need to have an actual figure to reverse engineer. And I would say, a lot of people say $10,000 a month. I'm sorry, I don't know if anyone noticed recently. $120,000 a year barely keeps you afloat anymore. So the $10,000 a month is even if you just wanted to throw that number out, you would have to work so hard to get there, and then you still wouldn't be satisfied. So let's just be more real. $15,000 minimum. That's going to be able to support a family in the lower middle class. Okay? It's being real here. After taxes, everything else, Susie's gymnastics and little Billy's baseball, everything, $15,000. Now, most people would automatically say, well, if you want to scale, you got to go multifamily. Well, most people don't realize that multifamily is one of the least profitable asset classes. Told you I was going to be negative this morning. I'm not meaning to be, but like, the truth is that most people don't realize is that the only way to profit in multifamily is through value add. So it's through refinancing, and so doing a value add, renovation or increasing the NOI. And then you can obviously pull your money out tax free. So a lot of people are like, well, just go buy crappy properties, undervalued properties, add the value, refinance them, pull out the money tax free, live off the money tax free, and just kind of keep repeating the process. But what you're doing is behind you, you're leaving this trail of a shitty portfolio that's over leveraged, that doesn't have any cash flow, that's not sustainable. because you're not building it out with enough cash flow. So, not to mention the fact that you are buying properties that have high turnover because they're one bedrooms. It's a whole other conversation for another day. But the truth is that plan there, multifamily is only profitable through value add, through the multifamily BRRRR strategy, essentially. And so what a lot of people like to teach is that they teach the get the money all out tax free. And they're like, okay, yeah, cool. Not only do I want financial freedom, $15,000 a month average, I also want it all to be tax free as well. So now you're looking for unicorn deals, trying to get your money out for tax free. It just doesn't work. I'm going down the wrong rabbit hole for today. Going down the wrong rabbit hole for today. The truth is that I think you should be looking at turnkey properties that have good cash flow. If you were going the multifamily route and you were getting about $50 per door after all expenses, and you needed $15,000 a month, you would need 300 units. And how much does a unit cost? Well, we're not going to talk about the Alberta units or the small town units in Alberta. We're going to talk about more realistically, the rest of Canada, which makes up a majority of it. Let's say it's $175,000 per unit. $175,000. Okay, that's $52 million. You got to put 20% down, right? So 20% of that means that you need $10,500,000 just to buy them today. No, it's okay, Gabby. We'll use joint venture partners. Joint venture partners, sure, not a problem. Well, that means you're going to be splitting half of that cash flow. So you'll need twice as much.
600 units.
600 units, or you'll need to raise $21 million. Are you ready to raise? Who's ready to raise $21 million? Never raised a penny in your life. You really think that someone's going to do this? That's what you would have to do. You'd have to go balls to the wall for the next X amount of years, 2 years. I want you to go and raise $21 million legally through your friends and family exemptions and accredited investors, which most people aren't doing it legally. Now, do you understand what I'm saying, that it's just not realistic? That's okay. I'll go buy single family houses. Okay, single family houses, they $150 cash flow in a best case. Not say $200 cash flow. It'll be really super nice, but you need 15,000. Okay, 15,000. There's a rule in the podcast world: never do math on a podcast. I was listening to a podcast yesterday, and the guy's like, "Oh, rule's thumb: never do math on a podcast." So there's a rule: don't do math on a podcast because you'll make a mistake. But I'm going to do this for you guys today, this morning. I really want to set some realistic expectations first, and then I'm going to talk to you guys about what you should actually be doing. But $15,000, if you're getting $200 a month in cash flow on a single family house, which is so incredibly rare, divided by 200 means that you would need 75 single-family houses. Single-family houses being somewhere around $400,000, let's say. So 75 times 400,000 means you need $30 million worth of single-family houses. And then you need 20% for that. So you would need $6 million. Wow, did I say $6 million earlier, Gabby?
I think so.
Oh, it's almost like I've had this conversation 4 million times. You need about $6 million, but that would be assuming that you can get all of those mortgages for those 75 properties, but which we all know you're not going to get more than 5, 6, 7, maybe 10 mortgages. So you might have to go the commercial route, which is a higher interest rate, which is going to reduce your cash flow, which means you'll probably need closer to 100 properties. It's okay. No, you can use joint venture partners, Gabby, right? We can use joint venture partners. And if that's the case, you would need $12 million and you would have to raise all of that, and you need 120 properties. Who's managing these 120 properties? Don't forget to add property management on there, which is going to reduce your cash flow, which means we're probably going to need closer to 200 single family houses, which is going to increase how much money we're going to need to raise as well. Shit. Those fuckers lied to me on stage. They fucking lied to me. How many people do you think just unsubscribed to my channel because they just realized that like real estate investing is just a fucking sham? Big fucking joke. Most people quit. These are the type of people that the ones that I've been coaching for a few years to have a good solid plan, that understand it and everything else. They're like, okay, cool, this is what I need to do. And then they get into year 2 or year 3 and they're like, I just realized that I don't really want to do any of this anymore.
Yeah, I don't think this is for me.
I don't think this is for me. You know what I realized through your coaching, Wayne and Gabby, is that like, I'm actually quite happy as is. I like my life. I like my life. You know what? You know, I said it earlier, and I thought about it a little bit more, and I think machining, working in a machine shop is actually very fulfilling. I think it's very fulfilling. I think that people don't really truly respect machinists as much as they should. I provide a service for the economy and for the world, and for, you know, and if I weren't here, then think about all the things we wouldn't have. Think about what machinists do for the world. So I think I'm just going to stick to machining, and I might just pick up another property or two. That's typically what people will do, right? This is where they lose their hope. And I'm not here to crush dreams. I'm here to set realistic expectations. Okay? No one, and I mean fucking no one, can win or beat me in a debate about this. Real estate investing is not hard. It's just the dreams that people sell you are unrealistic for the time frame that you're looking for. Now, Gabby talked about something really cool earlier, and that is just time and just like waiting it out. And what happens is if you were to buy 5 properties that, you know, let's say 5 single family houses right now, that cash flow $200 today. They cash flow $200 today, but what's going to happen is if you finance them over 30 years and you don't refinance them, let's just say you keep the financing the same, and every month you keep making your mortgage payments. Every 5 years, your mortgage renewal comes in and you hit renew, and you don't pull any of your equity out. What's going to happen is your mortgage payments are going to stay pretty much the same as long as your interest rates don't fluctuate too much at every new term renewal. But they'll stay more or less the same. And what's going to happen is that your rent is going to steadily go up over time. And your payments are going to stay pretty much the same. Now, they'll go up a little bit. They'll fluctuate with insurance and property taxes and whatnot. But what's going to happen more is you're going to see over time is that your rent is going to go up. And in maybe 5-10 years from now, your cash flow might be upwards of like $500 or $600 because the rents have continued to go up and the expenses have stayed relatively the same. So you might have been at $1,000 a month cash flow originally, but now you're at $3,000 a month cash flow. You see what I mean? That like over time, if you're patient, what's going to happen is that your cash flow will increase as long as you don't pull out any of your equity. If you go and do a cash out refinance, what's going to happen is you're going to borrow that money. And when you borrow that money, it's going to increase your mortgage amounts, which is going to increase your mortgage payments, which is going to keep your cash flow relatively the same over that period of time. But if you don't touch any of that, then your cash flow will go up because your mortgage payments stay the same and your rent has gone up, right? Alternatively, there is the possibility of doing a cash out refinance as well, but that would be a different plan. That would be similar to what we talked about last week, whereas every 5 years you double your portfolio essentially. You know, everyone remembers that, where it's like you had 2 properties and then you go refinance those 2 and now you have 4 properties. Right. 5 years from now, you refinance those 4 properties. Now you have 8 properties. You know what I mean? You can do that thing. You know what I mean? Yeah. And just keep on compounding. And that's another option as well. But just keep in mind that the cash flow it stays relatively low on each of those properties, but you have more properties. And I would say that strategy is better for building wealth and building equity than it is for building cash flow.
Which
you are multiplying.
Patience.
Yeah. You are multiplying. But I think that the benefit of that strategy is more on building more equity, right? It's an equity building strategy. It's not a cash flow building strategy. Yeah. Right? And if you did that strategy, just imagine you did the strategy I talked about last Friday, and you just kept on doubling and refinancing, yada, yada, yada. And then after 15 or 20 years, what you did was you sold the whole portfolio. You sold the whole portfolio, and then you took all that cash and put it into assets that have really good cash flow. And it's almost like a restructuring of your portfolio. And this is normally what I teach my students, is that like in the beginning, when you don't have $6 million to start with, because nobody has $6 million to start with, in the beginning, your goal is to build as much equity as possible safely. You have to be super aggressive. Yes, do the BRRRR strategy. Yes, do value add, multifamily. Yes, do this. Yes, do that. Yes, do rent to own. Yes, do fix and flips. You need to build as much money as possible, because the truth is that when you have money, when you finally get to a spot where you have a significant amount of money enough, then you can restructure your whole portfolio to have the total focus to be on cash flow. Not on building any more wealth. It's going to be on cash flow. And that's going to require you to be putting more money down. You're not going to be leveraging properties at 80% anymore, only putting 20% down. You're going to be putting like 50% down because your focus is on cash flow. It's paying you monthly payments every month. It's not on building the portfolio anymore. It's about paying you. And just understand your return on investment, your return on equity is going to tank. But the focus is for cash flow, right? So you have to figure out where you are in the journey. Do I have $6 million or $12 million? No? Okay. Well, you are in growth mode right now. You need to build as much equity as possible. You need to take what you have and make it what you need it to make it, right? What do you need to get it to? Well, we're going to need to figure out your target first, reverse engineer your target, come up with a plan, figure how much money you need, figure out how much money you have. What do you need to do today in order to get from here to here, from point A to point B, right? So for many of you guys, you just need to be super aggressive and just try and leverage as much as possible to make the little bit amount of money and resources you have right now to where you need it to be to build your dream portfolio that spits out the cash flow that you need in order to live your dream life, right? How many do you need? It depends. Depends on what your goal is. Depends on what the interest rates are at that particular time. Depends on what market you're planning on investing in. Are you stubborn? Like some people are like, no, I live in Brampton. I will only buy in Brampton. I'm not buying in Honolulu. I don't know anything about Honolulu. Yeah, I heard the cash flow is great there, but I'm not buying there, right? I will only buy in Brampton. And some people are so stubborn that they will limit themselves to like, I have to only, okay, well, here's the opportunities that are available in Brampton. They might not be the best opportunities, right? By the way, I don't know if there's any opportunities in Honolulu. Or I don't know if...
Or Brampton.
Well, I know that I wouldn't invest in Brampton. No offense. But it really depends on the market you're planning on investing in as well and what kind of opportunities are there. Some markets have really, really, really strong cash flow opportunities, but they might not have the best equity building opportunities, right? Some markets are like, okay, if you buy here, there's strong potential for appreciation. They're very stable. They got good cash flow, and there's good fix and flip or BRRRR opportunities there, which can be really great for building equity. Yeah. If you've got really good BRRRR opportunities there, then you can buy a property, renovate it, add value to it, and then refinance it, pull that equity out, and then just keep multiplying your portfolio, which is really good in a growth stage, but not very valuable when you're in a cash flow stage. You don't really need that opportunity when you're in a cash flow stage because when you're in a cash flow stage, you're just focusing on cash flow. Mm-hmm. Is everyone still following? This is a lot of information. Mm-hmm. You would not believe the notes that I have on my paper. I haven't even looked at any of them here. They were so incredibly simple. I was going to give you a beginner level episode, and I just took it so much further today.
Wayne, what's funny is I had a one-on-one coaching call with one of our students, and they told me that when they listen to the podcast, they listen to it on an increased speed. And yeah, and
how?
Well, it's funny because
how?
Ever since they said that, I've been paying attention to like how quickly we talk or how slow we talk. But the second we started the podcast today, you were like, like motoring through the information. So I feel like most people might need to actually like slow down the speed. Yeah. Like go back, re-listen and reduce the speed. I'm following along. Been doing this a long time with you, but I have a feeling that if there's some people starting out here, they might need to take it down a notch.
Yeah, I don't think that this is the episode for you. Well, maybe it is. Maybe it is because
I think setting realistic expectations.
I'm going to scare a lot of people away, though.
Well, some people need to be scared away.
This is not the episode that we would use to sell our REI Masters mentorship program because this is going to scare people away from real estate. Yeah. It's the truth. But to be honest with you, I mean, the people, well, I'll be honest, the people that do get scared, this mentorship program isn't probably for them. Mm-hmm. The mentorship program, like the people that we teach, are highly intellectual. They have realistic expectations and they're willing to work.
Driven. They're
very driven, right? But at the same time, they're not, overly ambitious to the point where they, you know what I mean? Where they kind of fall off. And, I've had some people like that in the past where they're like, yeah, I can do this. Yeah, I can do this. And then within 6 months, they just disappear. and they're trying something else because this wasn't fast enough. They're like, oh, I'm doing this now.
Yeah.
Forex, crypto, drop shipping.
Yeah.
That's way faster. That's going to put money in my pocket right now. And some people are not patient enough. So, so let's dial back a little bit. And I'm sorry, like, I don't even think I answered your question in your email, but,
I think you can get the point though.
well, okay. So there's restrictions, and I do have a couple notes that I want to touch on. So, he had mentioned cash flow, sell, refinance, etc. Let's talk about refinance. This is something that I talked to one of our students about last week. And he said, like, I really liked your strategy of like doubling up, refinancing every, as your equity builds. But he said, how long can I really do that? And I said, well, yeah, that was a podcast episode. So that was very generic theory on the podcast. And once we got it deeper into the coaching side of it, I said, realistically, I don't know how many mortgages you can get. It depends on your job. So you need a really good job, and you need to keep your debt servicing, your personal debt servicing, like your car loans and your credit cards and that kind of stuff, low, and your living expenses low in order to be able to continue to keep getting more mortgages. How many can you get? I mean, there's limitations. Every mortgage company, every bank has their own internal limits on how many doors you can have. And then there's debt servicing limits on the residential side. And so realistically, you will at some point, you're gonna hit a wall, and it really depends on you. I can't say each and every one of you guys are going to be different. So refinancing, I think that you will eventually reach a certain spot. It might not even be you. It could just be the property. You know what I mean? Let's say, for example, you bought a property for 300, you put 50 into it, you waited, and then now it's worth 700, but the rent is still 2,000. You think, oh, I'm going to get 80% of my $700,000. I'm going to get $560,000 mortgage. Yeah, but the property can't support itself. The $2,000 a month in rent won't support the $560,000 mortgage plus property taxes plus insurance plus. So it might not even be you. It might just be the property itself. It has grown too much in value, and the rent hasn't kept up with it, right? And so that could be a limitation that right there. It might not even be how many doors or how many properties. So refinancing, there are some restrictions and some limitations to that. Then he talked about selling. Well, when you sell, just do keep in mind that you have to pay the capital gains tax, which is half of the appreciation. So if you made, you bought it
Taxed on half of the appreciation.
Taxed on half, yeah. So if you made, I shouldn't be doing math. But if you made 300 and, you bought it for 300 and you spent 350 and you sold it for 700, that's $350,000 worth of gains. While you get taxed on half of that. So you're going to get taxed on 175,000 at 40% in taxes. So you're going to, $70,000 of that's going to go to taxes minimum. So, you could do that. You could just buy properties, wait for them to appreciate, then sell them, I guess, if you really wanted to. It's not the best strategy. And then he talked about cash flow. Well, we already talked about cash flow earlier. What if you just held it, didn't do anything to it, and just waited for the rents to go up? What if you were just patient? I think that's the best strategy. I think that this individual's 40 years old. Yes, you're in oil and gas. Yes, it sucks, royal dick. It's a piece of shit job. It's one Adam Sandler millennial that might get that. It sucks, but if you're patient and you just keep on doing what you're doing, you've accumulated, I don't know how long it took him to get to 9 doors. I don't even know how many properties that is. That one multifamily property, or is that 4 suited houses and 1 single family, or 4 suited houses and 1 apartment? I don't know. But, that's very impressive in today's lending landscape, with how hard it is to get mortgages these days. And he's done this all on his own, assuming no joint venture partners. I think you've done very well. If you continue to keep doing this and just picking up 2 or 3 properties every year for the next 15 years, keep building slowly, or even just 1 property every year. Just keep, making that sweet oil money, and just keep doing that for the next 15 years. You'd have 15 properties plus your 5. You'd have 20 properties. And by then, Think about all the mortgage pay down you'd have, the appreciation, the cash flow. I think at the 15-year mark is a really good time to go and see how much cash flow you have with your existing portfolio. And if it's not structured properly, then we could look at potentially restructuring your portfolio. Sell off the ones that don't need to be there, refinance the ones that need to be refinanced, right? And leave the other ones as is if they're totally fine. At the 15-year mark, you should be able to build up, if you stay consistent, you should be able to build up enough equity to be able to have options. Right now, you don't have options because you don't have equity. You don't have $6 million or $12 million sitting in your bank account. But if you did, it would be a little bit easier. If you came to me right now and said, I've got $6 million, I would show you exactly how to build it. But you don't, right? So you got to be patient until you get to that point. And I also want to add a side note here, take this in a different direction. The properties that you have right now might not be in your portfolio when you do that restructuring. The properties you have right now might be really good for building equity, but they might not serve a purpose when you start getting into the cash flow stage. So don't get emotionally attached to properties. Each of them serve their own purpose. What is the purpose of this property in my portfolio? Am I just buying for the sake of buying, or is there a purpose for it? This property is really good at building equity because there was a really good opportunity for a BRRRR or a value add. It also is in a very strong market that has high potential for appreciation. The rent compared to the expenses on this property are really strong, and the ROI is really good. So I put my money into it. I'm getting the best possible return on it, so I'm building lots of equity. That's why I'm holding this property. Don't just buy a property for the sake of buying a property. There needs to be some purpose and intention behind it. Right? But as you start shifting from equity building to the cash flow stage in 15 years from now, that property might not serve the same. It served a different purpose. So now it's time to either refinance it, sell it, whatever you got to do, and take the equity that you've built from it and restructure your portfolio into the total focus of cash flow. Right? My recommendation for you, and I know it's not what you want to hear, and I know that everybody else that's selling you something wants to tell you what you want to hear, but my recommendation is to be patient, keep doing what you're doing. And have just write 15 years down. Just write it down. And then it's like, it'll change your perspective. It'll give you a big paradigm shift. And then suddenly you're going to stop going into work every day and be like, this fucking guy fucking tell me what to do. I'm fucking better than this guy. I own fucking 9 doors and fucking... I did the exact same thing. It's hard. And then it makes every day hard. Right? And there's power in that. You can harness that in a way to propel you, but don't let it take over. But I think that if you just write down 15 years or a piece of paper, I don't know, it's maybe like you do it like a check every day, or you pull a sticky off or something like that for the next 15 years. That doesn't sound realistic, but just 15 years, just remember 15 years. Then it'll change your perspective on it and be like, okay, cool. It's going to take me 15 years, right? And just keep doing what you're doing. What you're going to find is that I said 15, realistically, it might be 14, might be 11. But if you say 15, whatever the outcome is, whatever the answer is, it's going to be less. And you're going to feel better about it when you actually get there. Because for me, it was 7 or 8. It actually happened a lot faster than what I was expecting. Right? And then it felt really good. I'm like, oh, wow, cool. That's awesome. Right? So let's say 15. Most people, I would say, if you just pick up one property a year, whether it be through joint venture, yourself, whichever, I think most people mathematically can get there in about 15 years. That's just how long it takes to build equity for your portfolio to appreciate, to build down, pay down that mortgage. If you put all your cash flow in the reserves, all that cash flow is going to build up as well. That's how long it takes. Now, how many rental properties do you need? Well, that's when we get to the cash flow stage. When we get to the cash flow stage, we'll figure out, okay, what's the best asset to buy for this? The better term I was trying to come up with earlier while I was talking. I couldn't really come up with something, but I almost want to call it like your distribution portfolio. Like right now, you're in wealth building portfolio, but later on, it's almost like a distribution portfolio, where it's like this portfolio is built strictly for distribution of cash flow, right? So what needs to be in there? Well, we want the least amount of properties that spits out the most amount of cash flow with the least amount of risk, right? We don't want to have to manage any of this shit. I don't want 300, that's for sure. That's just 300 problems. More properties, more problems. The least amount of properties possible that spit out the most amount of cash flow that I need for my whatever it is that I need. Let's say it's $15,000. If it could be one property, that would be amazing. One property, $15,000, that'd be amazing. Easy peasy, right? I don't want more because it just becomes more problems and more risk. So figure out the least amount of properties that spits out the right amount of cash flow that I need, right? With the least amount of risk. Because there is always risks in investment properties as well, right? That's how many properties you need. But, you know, if you have a $5,000 a month goal, or you have a $15,000 a month goal, or you have a $50,000 a month goal, it's going to be different for everybody, right? That's how many rental properties you need for the distribution portfolio. How many do you need for your wealth building or your equity building portfolio? Whatever it takes. Ideally, the least amount possible, because less is more in this case. Less means less work. I certainly don't want to be managing 100 properties for 15 years. I'm sorry. You got a shitty job. You've got a family. And I think that you would like to kind of sort of enjoy the next 15 years as well and not just be a slave. I'd say the less is more, but whatever it takes. You got to do what you got to do, right? The way I look at it is, how can I do this with the least amount of work and the least amount of stress, right? And find that sweet spot, build out a system that supports me, build out a team that supports me so that I can still enjoy my day today, you know, for the however long I need to endure this. And that you can still take your kids to gymnastics and little Billy to baseball, right? Because there's no point in doing it for 15 years and then missing all of Billy's Little League games. Now he's going to the big leagues and he won't even mention your name at the press conference because you were an absentee dad or mom. Dad was never around. He was always at the rental properties fixing fucking toilets. Screw you, Dad. I showed you. Look at me now, playing for the Mets. That sounds terrible. Anyways, maybe I was exaggerating a little bit there. You get what I'm trying to get at? There is no real answer. It really needs to be designed and tailored specifically for you. Now, there's a lot of people out here that are new to real estate investing right now, and I hope you made it through the 58 minutes. A lot of you guys just have $100,000 or $200,000 that maybe you've saved up, or you perhaps inherited from a family member that you really love that passed away, and you just want to put it into something that you think is going to get great returns, and it's going to be a safe investment. And the answer would be exactly the same. Less is more. And don't listen to anyone that says like, "Oh, look at this, you're going to be able to..." Just focus on why you were here in the first place, and focus on the return on investment, which is what you were hoping for, right? You were hoping to get good returns compared to the money that you put in. For every dollar you put in, you want to get a decent amount of money back, right? So you want to focus on the return on investment, and you want to focus on the risk. The return on investment is what you do is you take your total returns and divide it by the money invested. That number right there is the metric that you use to measure each individual investment to determine what the return on investment is, okay? That's how you determine how profitable it is. If you want to figure out what the risk is, you just look at the cash flow. Okay. And if you want to know how much cash flow is sufficient for a portfolio so that you can weather all the potential storms, we have a rule that we call the 5% rule. And there's a great book on Amazon. It's called the 5% rule, cash flow test for Canadian real estate investors. You can go pick it up. It's a very easy read, 69 pages, small little book. Teaches you everything you need to know about how much cash flow you need in order to make sure that you have a sufficient amount so that your portfolio is never at risk. Okay. That's it. For most of you guys, that's all you need right there. Focus on the ROI and focus on the cash flow test. Just buy good properties and sit and be patient. Okay? Don't expect to get higher returns in the first 5 years. I'm not saying don't expect to get returns in the first 5 years. What I'm saying is that like your wealth is built over the long term. So you're going to see you're going to see that the average annual returns over 20 years is going to be higher than the returns in the first 3 years. Okay. A lot of times in the first 3 years, you got repairs and you got things and you got vacancies and a lot of the mortgage payments going towards interest and none of it's going towards the mortgage. Like it's a long-term game. But if you just go buy a few properties, 2 or 3 or whatever you can afford, less is more, less is always more, and just sit on them and just manage the hell out of them and just be patient. 15, 20 years from now, you're gonna get some really, really good solid returns. Solid returns. That's if you're looking for something just chill, right? Not everybody has to go and reach for the stars. Most people, I don't know, I was going to make like an Apollo 11 joke, but most people never get off the ground.
Yeah.
Was it Apollo 11 that blew up? Somebody in the chat, help me out here. Jamie? Yeah, we'll figure that out. Was it valuable, Gabby, or do I need another hour to add more context?
I was just about to say that I feel like there was tons of value in here, but I feel like tomorrow, I feel like tomorrow we could almost dive into, because in this question that got emailed in, it was, I want to leave my oil field job.
Yeah.
And maybe tomorrow we can discuss what needs to happen for people who think that they're getting into real estate investing to be able to quit their jobs.
Perhaps. The one last thing that I didn't add on here, which was part of my original notes.
Leanne said loved it, by the way.
Huh?
Leanne says loved it.
That's great. Yeah. Thank you. I think that I'll get back to what I was going to say in a second, but I think that if you listen to me long enough, you're going to realize that my focus and the focus that I try and teach is on where it should be and away from where it shouldn't be. And my focus generally tends to lean more towards balancing the risk, enhancing the probabilities, but more so enhancing the lifestyle. And what people tend to do is they go balls to the wall, dedicated to driven to go for something, which is great. Again, it can be great. But then they neglect and they ignore the most important things in life, which is the whole reason why you got into it in the first place. Your family, your loved ones, and what you actually love doing every day. And that's why I see so many people fall off around the 2 or 3 year mark, even the most dedicated, driven people. It's because they realize I don't want to live my life like this anymore. And I'm actually quite happy with what I had. But if you had that perspective and that belief system from day one, maybe you could tweak the dials a little bit to still use that energy and that drive that you have, but be further ahead with the right perspective along the way. Go into it and be like, okay, I don't need that. I need this, and I can be patient. I'm going to build out a life and a routine that's doing a little extra every day, a little extra 10% every day, which is going to get me so much further ahead 15 years from now, right?
Yeah.
As opposed to, it's the tortoise and the hare. It's the fucking tortoise and the hare.
Finding the balance.
It's finding the balance, building out a good plan, a good routine every day that's sustainable so that you actually get further ahead and you actually finish the race.
Yeah.
Most people never even finish the race. They might start off really strong, but they never even finish it, right? Because they wanted to get to it so fast. They got cocky, right? I want to see people actually make it, but I want them to build out a solid plan for how to actually finish, right? There's too many people that never actually finish, and it's so sad, right? But it was because of, I don't know, it was unrealistic expectations.
Yeah.
They thought that they could have it all in a couple of years. So there are some options, getting back to what I was going to say earlier, there are some options for the listener that sent in the question. But I think that it's maybe just changing the perspective of the fact that I can buy rental properties or refinance them, get all my money out tax-free, and just buy enough to get enough cash flow. If you want it now, you need to go on a completely different plan. I'm going to say something, and maybe this might not come, but just for this individual, because I remember he sent me a message, I don't know when, months ago, years ago, something like that. I remember a message he sent me, and he said that I don't need your mentorship program because I already know all the stuff that pretty much I'm going to learn. And I totally understood that. Sure, not a problem. I think he was just looking for just like one-off coaching. But a lot of this is what we teach. A lot of this is what we teach. And a lot of it is theory and fundamentals and stuff like that, but like building out a good solid plan. And for you, I think that he has figured out how to get the properties, how to get the financing, how to build it all out. But he didn't do it with a plan. And just kind of, and a lot of people get into it. There's buy properties. Yeah, I'm doing stuff. There's movement. Things are happening. But is every decision intentional? And there's a lot you can learn about, how to build a proper plan so that every property serves a purpose and it's getting the best possible return, not just on investment, but on your time. And there's a reason why it's there. Because sometimes buying a property, even a really great deal, undervalued or great cash flow or something like that, it might not actually serve a purpose in that portfolio. And you could have better utilized those funds on something else that would have maybe built more equity over the long term with a little bit of planning, preparation, and intention. So it's hard for me to tell people that when they don't know me all that well, and it's just not going to come over. It's not going to come across all the right way. But I'm very much a planner, and I'm very intentional. So I hope that makes a little bit more sense to the individual that I'm talking to right now, and to anybody else as well, right? I don't want to do the cliche thing, but I'm going to do it. Build a plan or plan to fail. Is that what the old saying? I'm off by a little bit.
Yeah.
That's why I don't do quotes. Something like that.
In the comments here, Kyla says, wish we found your program and podcast when we first came here. Dan says, same, Kyla.
Mm-hmm. And for anyone that's in our mentorship program right now, they're like, wait a second, I haven't had any of these conversations with Wayne yet. You're not there yet.
Mm.
There's a few people that might even be here right now that are like, oh, wait a second, I want to start having these conversations. Chill the fuck out. You're focusing on the theory and the fundamentals right now. So there's different stages for everybody. And this is coaching. I wore my coaching shirt today. That's great. This is just coaching, just like focus. I am also working on making sure that everybody is focusing on the right things at different times, because sometimes if you give it all out too fast, then it might be too much information and they're not focused on the right things. So focus and intention are very important with success in real estate investing. Anybody can buy a property and it could be profitable, but actually building a portfolio that's intentional, that gets you to your goals, that's a different story, right? I hope I made sense today, because this is some pretty advanced stuff that I don't normally talk about on the podcast, but I think it's going to provide some value for a lot of people here today. And let's try and continue the conversation tomorrow. But what I want to focus on tomorrow is more on the active income side, which I think is going to be very beneficial for this listener that sent in the question, because I think that you can keep on building what you're building right now, and just keep picking away and just slowly adding. But let's maybe focus on some more active income to support your short-term goals of being less reliant on your job, which comes with its own risks, but we'll talk about all the different active income opportunities in real estate investing tomorrow. Sound good?
Love it.
All right.
Have a great day, you guys.
Thank you guys so much. We'll see you all on Tuesday.
Thanks for listening. Want to be coached personally by Wayne and Gabby? Then you should join the Real Estate Investing Masters Mentorship Program. Details are in the show notes to get started.